Hi, everyone. I'm Dave Allison, chairman of the investment committee here at Prosperity Capital Advisors. Our investment team, working alongside our partners at BlackRock, just made a change inside of your pre tax portfolios. And I wanted to walk you through exactly what we did and, more importantly, the thinking behind it. I'll go through this the same way that our team looked at it, slide by slide. By the end, my goal is that you understand not just what changed, but why, and why we believe it leaves your portfolio in a stronger position. Here's the headline, and it's the through line for everything that follows. We remain optimistic on markets. We're still positioned for growth, but after a very strong run, we've made a deliberate choice to be more selective and better diversified. On this slide, you can see the actual moves. On the equity side, we trimmed our overweight to stocks. We increased our preference for US companies over international, and we held firm on our highest conviction themes, large cap and AI driven growth. On the fixed income side, we introduced a new, more dynamic diversifier. I'll unpack these, but the one sentence version is keep our best ideas, trim the broad exposure, and add better shock absorbers. Before the changes, let me set the backdrop because it explains our reasoning. This year tested investors' nerves. We had real geopolitical shocks, and in those moments, the instinct is often to sell and wait until things feel safe again. The problem is that markets tend to recover faster than headlines do. The chart here shows two recent scare episodes. In one, the market took 55 days to recover its prior high. In the more recent one, just 11 days. If you sell into the fear and wait for the all clear, the market often doesn't give you a clean chance to get back in. So our approach has been to stay anchored to our process, adjusting exposures gradually as the risk-reward picture shifts rather than reacting to the emotional temperature of the news. Staying invested through the noise is a big reason your portfolios have done well. That said, discipline doesn't mean complacency. The risks haven't disappeared. The market is just paying less attention to them. And you can see that on the left side, shipping traffic through a critical oil choke point dropped sharply, a real on-the-ground signal of disruption, even as the news coverage faded. Behind the scenes, a few things quietly shifted. Energy prices moved higher, interest rates moved higher, and expectations for the Federal Reserve flipped meaningfully from anticipating several rate cuts to, in some scenarios, pricing in a possible hike. Meanwhile, recession odds barely moved. None of these are flashing red, but together they're enough yellow flags to make us want to be intentional about where our risk lives. That's exactly the kind of backdrop that argues for trimming broad, blunt exposure without walking away from the upside. This slide gets at why we express our views with precision rather than broad strokes. An energy shock doesn't hit every region the same way. Under a high oil scenario, Europe takes the biggest hit, more inflation, weaker growth, because it imports most of its energy. China feels meaningful pressure too. The US is far better insulated thanks to domestic energy production and a more service-driven economy. The takeaway for us is simple. The same shock creates different winners and losers around the world. So rather than trying to trade oil directly, we prefer to express that view through where we invest regionally. It's a more surgical way to manage risk. Here's a development worth understanding because it adds to policy uncertainty. There's a new chair at the Federal Reserve, and he prefers a different way of measuring inflation. Under the traditional gauge, inflation is running around 3.2%, above the Fed's target. Under his preferred gauge, it's closer to 2.4%, much nearer to the target. So, why does this matter to you? Because the measure the Fed emphasizes influence when and whether it cuts interest rates. A shift in the lens could justify a more dovish, lower rate path, but it also raises credibility questions. It can look like changing the measurement to get a more comfortable answer. Adding to the uncertainty, the prior chair is staying on in a reduced role, which can create mixed signals. For us, the lesson is not to make a heroic bet on the exact timing of interest rate cuts, and instead keep our bond position balanced and resilient. So, with all that caution, why are we still optimistic? In one word, earnings. This market hasn't run up on hope. It's been led by real improving company fundamentals, especially among large technology and AI related businesses. Analysts keep revising their earnings expectations higher for those companies, while the rest of the market has been roughly flat. And here's the interesting part on the right. Many professional investors are still underweight these exact companies. So the most visible winners aren't the most crowded trades, which leaves room for more buying rather than forced selling. That's what we're keeping our exposure to, these earnings engines, while trimming the broader equity risk around them, where the earnings story is less clear. Now, this slide reinforces the case for being selective overseas. Look at the spread. The best performing country market is up around 73% this year. The worst one is down around 27%. And the winners and losers don't line up neatly by developed versus emerging. Returns are being driven by each country's own fundamentals and policies. When dispersion is this wide, a broad, just by international approach leaves a lot on the table. That's why we use an active country by country selection strategy to lean into markets that are working and try to avoid the ones that are dragging. It lets us keep international exposure that's additive without turning it into a blunt macro bet. Now, to the most important structural idea in this update. For decades, bonds played a dependable role. When stocks fell, bonds usually rose and cushioned the blow. But in a world of higher inflation and higher rates, that relationship has become less reliable. You can see the regime change on this chart. More recently, stocks and bonds have at times fallen together, which defeats the purpose of holding bonds as a safety net. This is what we call the diversification dilemma. Bonds still matter for income, for stability, but they can no longer be treated as the only shock absorber. The role needs to be more intentional, higher quality, cleaner duration, and not built on the assumption that rates will always fall exactly when stocks need help. So here's our solution to that dilemma. This slide is a stress test from 2022, when inflation surprised to the upside, stocks fell almost 7%, and bonds, the supposed safety net, also fell. But liquid alternative strategies shown here actually held up and added a bit of value. That's exactly the behavior we want from a diversifier. Something that doesn't simply rise and fall with the stock market. In plain terms, a liquid alternative allocation is a flexible, professionally managed sleeve designed to generate returns from different drivers, aiming for a smoother ride when traditional fixed income struggles. And one key detail, we funded this from the bond side of the portfolio, not from your stocks. So your growth engine stays intact while your defense gets stronger. Let me tie the whole thing together. There are three key takeaways. First, we're still bullish, but we reduced our equity overweight. That's not a call that the market has peaked. It's simply reorganizing that the extra reward for being heavily overweight has cooled after a strong rally. Second, we concentrated our active risk in our highest conviction areas: AI and innovation, US over international, and growth. Where conviction is lower, we pulled back. Third, we diversified away from a pure reliance on bonds by adding that bond-funded liquid alternative allocation. The cleanest way to say it: keep the winners, trim the blunt exposure, and strengthen the diversifiers. Still constructive, more selective, better diversified. If you prefer the picture version, this is it. These dials show how we're positioned today versus before. You'll notice we're still on the risk on side, still tilted towards stocks, towards growth, towards the US. But each of these dials has eased back just slightly from where it was. That's the visual story of this rebalance. Still leaning into opportunity, just a bit more deliberately, with a stronger foundation underneath. One important note about how this applies to your account specifically: this change has gone in effect in your pre-tax, tax-deferred accounts, things like IRAs. In your taxable accounts, those after-tax or post-tax accounts, we take a different approach, one with an added priority: tax efficiency. There, we're always weighing the benefit of a trade against its tax cost, so we can maximize your after-tax returns, what you actually keep. So if you look at your taxable accounts and don't see these same exact changes, that's by design. It's not an oversight. It's deliberate, tax-aware management working in your favor. The philosophy is consistent across all your accounts. The implementation is tailored to how each one is taxed. I want to leave you with one practical thought that ties all this together. Markets are near all-time highs. That's a good thing, but it's also a natural moment to step back and reassess your plan rather than just your portfolio. Specifically, it's a good time to revisit your soon and your later buckets, the money you'll need for income in the near term versus the dollars meant to keep growing for later. After a strong run-up, the balance between those buckets can drift. So the questions worth asking are: is your soon bucket funded with the right amount and with the right level of risk to cover your income needs over the next 5 to 10 years? And is your later bucket still positioned for long-term growth you're counting on? When markets are strong, you have the flexibility to make those adjustments from a position of strength rather than being forced to react in a downturn. That's exactly the kind of review your prosperity advisor can walk you through. So if it's been a while since you looked at how your income timeline is funded, reach out. It's a conversation worth having while conditions are favorable. As always, if you have any questions about how any of this applies to your specific situation, your prosperity advisor is the right person to talk to, and we'd encourage you to reach out. Thanks for watching, and thank you for your continued trust in our team.